Oops. Welcome back to another minutes from the Federal Reserve Review. Let's see if the Federal Reserve is going to rug pull us today, or is Nvidia going to rug pull us today, or both of them going to rug pull us today. I have no idea, but we're about to find out what the future holds for us. We have the Fed minutes coming out within the next, looks like we've got 3 minutes to go to Fed minutes release. A lot of expectations here. Last set of expectations we went through were from Citi. Citigroup gave us some good expectations for the Fed. Mostly, some of the concerns are that the Fed may try to revise the minutes. So that's going to be the biggest thing that we're looking for is there going to be any revision? See, the minutes are actually put together after the meeting. The meeting happens, they put together a transcript. But the minutes, which is sort of the summary, can be used as a messaging tool. So because the minutes are put together, obviously, in the weeks after, I mean, it's been 3 weeks since the Fed meeting, what can happen is the Fed could say, oh, let's prioritize this and not that in our conversation or our discussion of the minutes. The benefit of that is it gives the Fed another messaging tool. Now, remember, when the Federal Reserve went into the meeting for the November 1st FOMC meeting, the Federal Reserve suggested, hey, we are going to, not raising rates right now, will be data dependent, but yields were higher then. They're like, financial conditions have tightened, so we don't have to do as much. Well, at the time of that meeting, the 10-year Treasury was 4.8%, and financial conditions were a lot tighter than they are now. If you look at, for example, Goldman Sachs Financial Conditions Index, that's just one of the many that Fed Chair Jerome Powell references or sometimes uses. The financial conditions have substantially loosened. If you're watching on video, what I'll do is I'll put up a screenshot of financial conditions loosening, and that is a risk factor for the Fed potentially wanting to give us a hard minutes hit here. As you can see, here's the on screen now is the financial conditions index. You see that drop there. So here we go. We should be out with the minutes now any second. It is now time. Here we go. So it is now 11 even. We are waiting for the minutes to drop. Minutes have not posted yet. They're usually always on time. That's okay. Waiting for it to hit the wire right now. Okay, here we go. Everyone on the FOMC saw rates remaining restricted for some time. Everyone agreed to proceed carefully. They see further tightening if inflation progress is insufficient. Remember, that is different from not having from a strong economy leading the Fed to have to do more. That's different. You're okay with a strong economy as long as you don't cause inflation, right? It's a very big deal. Thanks, Jack, for bringing me coffee. Okay, let's go ahead and get the actual minutes up on screen. We've got them here. Okay, and 3, 2, 1. There it is. Boom. We are live. Thanks again, Jack. Okay, we have, here we go. Staff review of economic situation. Data available. Economy expanded at a strong pace. Consumer price inflation remained elevated. Okay. Labor demand and supply were slowly moving back into alignment. Easing labor imbalances were apparent in the wage data. That's what we want. We want that. We don't want a wage price spiral. Okay, so this is good so far. Key takeaways that Bloomberg just put together looks like with GPT probably. Fed staff expected below potential growth over the next 2 years. Roughly flat unemployment rate between now and 2026. All officials supported the decision of holding, no dissension yet. Policymakers attributed the rise in bond yields to persistent changes in financial conditions. Again, those financial conditions have substantially loosened over the last few days here. Right now, it looks like if we look at sort of the 1-minute chart of what's going on in the market, nothing is changing. Policymakers agreed that the Fed was in a position to proceed carefully. We already know that. Okay, let's look at the actual verbiage here. Although total non-farm payroll rose at a faster pace in September, unemployment rate unchanged at 3.8. We already know that. CPI remained elevated. However, continued to show signs of slowing. Okay, good. We like to see that. PCE was well below the earlier year levels. Good. That's a way of starting to kind of declare that victory, right? Suggesting, oh, look, this is their word, not mine, well below their earlier year levels. Survey measures of medium to longer term inflation expectations remain in the range seen in the decade before the pandemic. This is that's almost a way of saying flexible average inflation targeting right there. Remember, the decade before the pandemic, we had about 2.2 to 2.4% inflation expectations, and we had 1.7% inflation. Guess where we sit right now with the 5-year break even? 2.3%. 2.38% on the 5-year forward. So we are right in line with expectations. That's good. This is very good. Okay. Everything's taking longer than we expected, but we're on the right path. Real exports and imports of goods services grew at a robust pace. Remember, folks, China and Germany, they are exporting deflation to us. Deflation is being exported to America. This is fantastic. This is also very good for Tesla, mind you. Foreign economic growth remained subdued in the third quarter. Monetary policy restraint weighed on activity abroad, especially in Europe. Euro area GDP registered a small decline. That's true, is about 0.1%. Inflation abroad remained elevated. Core inflation continues to ease with a slowing in aggregate demand. Remember the price cuts that we're seeing at Vans, at Costco, at Levi's. Let's see. We have officials saying that tightening in financial conditions that we saw before the meeting, but some of that, again, has been unwound since then. Okay, we know that. I'm just trying to see if there's any new messaging here. So far, it doesn't look like they snuck in any kind of revised messaging. Financing conditions continue to tighten further. Financing is different from financial conditions. I know that's weird, but financial conditions are stocks, bonds, financing conditions, everything together. Financing conditions themselves are, what does it take for you to get a home loan or like a SoFi loan or whatever, right? Market implied path for Fed funds rate through 24 declined slightly. That's right, because we think we're basically at the top. Broad stock price indices declined. Well, since then, they've actually been going up. Okay, let's keep going here. Conditions, short-term funding markets remain stable. RRR, reverse repo facility, has continued to decline over the period. It's the RRP, actually. Get that right. Keep in mind, QT, a lot of people are really, really afraid of QT, quantitative tightening. We're tightening by about $80 billion a month right now. Max is screaming. Hold on, let me close the door. And that tightening is going to continue for probably about the next year. But a year from now, we'll be tightened by another $960 billion, which means all of that reverse repo facility will be empty. You'll have completely burned through the reverse repos, and that is that sort of explosion that we saw starting in about March of 2022 as some of the reserve requirements were changed post-COVID. Anyway, interest rates on commercial industrial loans and small businesses increased, as did loans to households. Rates moved up a broad amount as bonds went up. Okay, this is looking a little bit in the past because we know we've already unwound some of this. Sleuth survey reported, this is the loan officer survey, more tightness. I think it's too soon to speculate on like a rocket mortgage to come back. We were talking about that in the course member live stream this morning, mostly because 90% of people have a rate locked in below 4%. So just because you go from 8% to 6% doesn't mean you're going to get a boon in refinancing. Yeah, obviously the some people who unfortunately got rates in 8%, they might refinance, but that's a small number of people. So it's not the kind of bet I would want to make. Those are by the way, the kind of questions that I answer in the course member lives. If you're not a course member yet, Black Friday sale is on. Go to meetkevin.com to learn more. A lot of different options for you there. The most frequently cited reasons for tightening in C&I commercial and lending here include concerns about economic outlook, less favorable, uncertainty. Remember what Best Buy talked about this morning on the Market Open live stream channel this morning? We were talking about Best Buy, Lowe's, both of them seeing less spending. Best Buy reporting a 7% decline in year-over-year sales in November, as well as forecasting worse sales going into Q4. Same thing for Lowe's. Abercrombie did well, but for some reason, clothing, Abercrombie and Dick's, they're doing great. But in terms of electronics and home spending, they're the ones getting whacked. And that is going to lead to deflation. We are going to see price decreases, in my opinion. Credit remained available for high credit score borrowers. We have leverage in the financial sector was characterized as notable, which isn't great, seeing leverage at banks, however, still believing in banking stability. Okay, fine. Delinquency rates for non-residential commercial real estate picked up. I believe commercial real estate is probably in a bubble. That is a problem for commercial real estate. However, that will destroy equity well before it affects banks because that's the debt portion, right? You have to go through a 40% decline in equity first before you start hurting debt. Policymakers saw the inflation risk weighted to the upside. That's fine. Only a few participants said that QT could continue after the Fed starts cutting rates. This will be a big debate coming up. Can you start cutting rates at the same time as conducting QT without causing any kind of screw up for markets here? QQQ has basically been flat during this readout so far. It looks like the 10-year Treasury is up about 1 basis point, so also pretty well consistent with expectations here. PCE inflation projected to move lower in the coming years golly, everything takes longer, eh? As supply and labor move back into balance to trend back to 2%, that's fine. Additional monetary policy tightening that would be necessitated by higher or more persistent inflation. That's what it would take. Notice they've separated from this idea that we just want the economy to be weaker. I think they've realized they've done enough damage to the economy, and now's just the time to relax and watch inflation trend down. If it pops back up again, then you hike again. But markets are not pricing in another rate increase. We're starting to price in cuts now of about a 25% chance we start getting cuts as early as March. Participants judged the current stance of monetary policy was restrictive. The question is, what is quote unquote sufficiently restrictive? That's the debate on the verbiage. Participants noted inflation had moderated. Participants continue to view the potential for below potential growth. Look at that change in verbiage here. This is the same thing we saw Jerome Powell talk about last time. Rather than talking about below trend growth, we're talking about below potential growth now. Kind of flip-flopping on our definitions there. Several participants added that delinquencies on auto loans and credit cards had risen for households. We're starting to get more of that anecdotal insight that, hey, the Fed actually does affect people's livelihoods, and you really do have an opportunity here to screw things up. Keep in mind, wow, dude, Dick's Sporting Good was up 10% this morning. It's only up 3.7% right now. So Dick's basically just crashed by about 7%, and Open Door is already down 7%. On the day. Very interesting. Tesla still holding on to some gains here at about 2.4% up. That's because all the other loser automotive manufacturers have no PP at all. Tesla's the only one with a PP. And it might be a shrinking PP, but that dang thing's still pretty dang large. That leftover pricing power. People are like, man, stop. You got too much pricing power. You have to start walking that back a little, Tesla. You're making everyone else look bad. Business fixed investment was flat in the third quarter. That also hurts companies like Enphase. In commercial installs, and so does it for Tesla for commercial installs. Business contacts reported that cost increases could not be easily passed to customers. Thank God. This is what we want. We want businesses to go, damn it, we can't raise prices anymore, because that's how you start getting deflation. Businesses like Best Buy, Lowe's, Costco, Levi's, Vans, all of them, the grocery stores, the restaurants, all of them are going to have to start cutting prices substantially. The only space you're not seeing price cuts is in aerospace and skiing. Those two things that happen to really bother me. But anyway, participants observed that the labor market remained tight. Payroll growth was unexpectedly strong in September, and unemployment remained low. Nevertheless, participants assessed that a labor supply and labor demand were continuing to come into better balance. Measures of labor supply moved up. That's fine. Participation up. Availability of childcare is up, which allows more people to participate in the economy and get a job at work. Wages are still rising at levels above those generally deemed consistent with 3% inflation. I don't know if that's true. I want to take a look at that. Like if we go to our BLS data, which the last BLS data, which came out after these minutes, came out on the 3rd. Okay, so if I look at average hourly earnings, we had a survey of 0.3% month over month. We came in at 0.2% month over month this month. 0.2% is absolutely consistent with 2% inflation, because 0.2% is 2.4% wage growth. You know what's actually consistent with 2% inflation? 2% inflation equals, because wages it has to translate through the economy, 3% wage growth. You're okay having 3% wage growth to be consistent with 2% inflation. And as of the last labor report, we're at 2.4%. So, I'm not particularly seeing that. Year over year, we are elevated, though. Year over year, we're at 4.1. So we're still kind of working down to that 3%. But we are on a monthly basis getting there. Participants also noted that there has been limited progress in bringing inflation down in core services, ex-housing. This takes time. You really have to, get a substantial amount of additional labor available. So I don't know if that's going to require unemployment. If we start getting waves of unemployment, that's when we have a very bad economy. That's when the bears will be right and justified in shorting and selling the crap out of this market. If we do not get rapid unemployment, the bears will be woefully wrong. It's very simple. That's what comes down to. Unemployment stays this strong. It doesn't matter if year over year we're negative 0.1% in GDP and we're technically in a recession for 2 quarters. That does not matter. Unemployment drives everything, and because that could drive real fear. But we're not seeing it yet. But again, the problem is unemployment is lagging substantially, like 6 to 12 months of a lagger. So, both options are a reality. Many participants observed that a range of measures suggested that the rise in long-term yields have been driven primarily or substantially by a rise in recent term premiums on treasuries. Basically, people aren't interested in buying treasuries because Bill Ackman was shorting them. The big short on treasuries really manipulated the treasuries market and kind of did some of the Fed's work for them. Okay, so obviously no indicator here in this so far that the Fed is done, but let's be real, markets are pricing in that the Fed is done. The Fed's basically done. This is almost consensus at this point that the Federal Reserve is done. I will also, by the way, be covering the NVIDIA earnings and earnings call. It will not be on this channel. It will be on Meet Kevin Live. That's where we do market open and close. So if you ever want to come for the bell, I do the bell exclusively over there, market open and live. That's every morning the market is open, 5:30 a.m. or 5:25 a.m. And I will do closes when I feel like it. Yeah. But anyway, you can get that on the Meet Kevin Live channel. It's linked down below. Downside risk participants cited the possibility that effects on households and businesses of cumulative policy tightening and tighter financial conditions could be larger than expected. Oh, here we go. Hold on a second. Downside risks. Participants cited that the effects of cumulative tightening could be larger than expected. Oh, kind of like inflation was larger and longer lasting than expected, huh? Could weigh on household spending more than previously expected. This is so dovish. How are you going to get a hike out of them? You know what the chance of a hike in December is? The December 13th meeting? 0.2%, folks. 0.2%. You want to know what the odds of a hike in January are? 2.1%. You want to know what the odds of a hike in March are? 1.4%, with now a 31.4% chance of a cut in March. Oh, man, clearly I need some more coffee. Holy smokes, I'm dying over here. No energy left. Upside risk to inflation. They're going to leave that verbiage in there. This is such nonsense. Let me quickly see what the suits are saying. Okay. S&P barely budges. S&P dropped from overbought levels just by about 20 basis points. Big deal. Small businesses get a mention for their difficulty getting a loan. Smaller firms are finding it harder obtaining credit. Yeah, no duh. Fed policymakers cited the fiscal outlook as the leading reason for the rise in yields. That's the debt problem. Which there are bears who say that the longer-term fiscal instability in America will lead yields to be higher for much longer. I agree that our deficit problems are highly unstable, but I don't think that is going to actually be what drives yields higher for very, very long. I think rates are high now, and they will come almost straight down over the next year. Almost certainly, in my opinion, hashtag not guaranteed. By the way, shout out to the Meet Kevin Politics channel. This morning, I went through Donald Trump's immigration plan and his mass deportation in tent city plan. So if you want to see a summary of that, just a quick 17-minute breakdown, watch it on 2X. Just type into YouTube, Meet Kevin Politics, Donald Trump. You're not going to see it on the main channel and keeping the politics away because of what you all have requested. I'm listening to the audience. I've also started bringing back the archive videos so you can start seeing those as well. They'll all be back soon. A potential for broadening of armed conflict was seen as presenting an upside risk to inflation. In their discussion of financial stability, participants observed that the banking system was sound and resilient. That's fantastic. We really with the Fed bailout facility, we don't actually expect that you're going to have a banking crisis again. It's possible, but it just seems unlikely with the Fed's bank term funding program. Many participants also commented on the risks associated with a potential sharp decline in commercial real estate valuations, which could adversely affect banks. Remember, the way debt works on real estate is you have to burn the equity down first. Then you start hurting debt. So you got to go through about 40% equity first on the offices. Now, if the office buildings sell for 30 cents on the dollar, that's when the banks start getting hurt. Okay, several participants noted that potential cyber... Oh, they're just mentioning it here. They're not saying how bad it could be. They're just paying attention to cyber risks, commercial real estate risks. Well, that's boring. Okay, data. Participants expected the data arriving in the coming months would clarify the extent to which disinflation was continuing. Some policymakers have argued that the Fed needs to mainly focus on inflation data, correct? However, joblessness rose to a 2-year high of 3.9% in October. Okay. Line from the staff section is important. The increase in longer-term yields appears to be mostly attributed to higher term premiums. We already read that. I'm looking at what Wall Street is saying and obviously the notes here at the same time. Just take a deep breath for once in a while. Amid these economic conditions, all participants judged it appropriate to maintain. So you still have consensus, no dissension yet. Carefully proceed. Participants expected the data arriving in coming months would help clarify. There it is. That's what Wall Street just said. Participants noted the importance of communicating clearly. Big deal. That's just because they don't want people to go YOLO again. Let's be real. It's going to be a volatile V-shaped recovery. It's that simple. And I want you to remember this because I see the comments. Okay, I understand. I want to hear you, and I want you to have my perspective on what you are saying. I see the comments of people like Kevin. We are basically almost at all-time highs on the Qs, okay? The Qs, all-time high was 403. We're sitting at 387. Okay, let's do some quick math here. Let me do some quick math, okay? 403 divided by 388. That puts you, the other way around. 388 divided by 403 puts you at about 3.8% from all-time highs on the Q. But wait a minute. If you now inflation adjust, add 18% to 403, you are actually 19% away from all-time highs, inflation adjusted. So inflation adjusted, the Qs should probably be 475, which puts you right about here. And then people are going to look and go, oh, damn, this is actually starting to look like a volatile Nike swoosh. Damn it, Kevin. Damn it. It's okay. I sure love everyone. But with inflation still well above the committee's longer run goal, we see upside risk. Okay, this is redundant. Committee policy actions. We've already gone through the committee policy actions. Members agreed in assessing the appropriate stance of monetary policy. We'd continue monitoring. I want to see if they said the word recession in here at all. Recent indicators suggest economic activity expanded at a strong pace. Banking system sound and resilient. Blah, 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 blah. That was the statement. We already know that. Let's look for some keywords. Let's look for the word recession. No word recession. Give me some words. Give me some words in the chat, please. Give me some words we should look for, okay? We have 2 mentions of the word disinflation. Disinflation as upside risks to inflation. Participants cited the possibility of progress on deflation stalling or inflation reaccelerating because of momentum in economic activity. I don't see it, but whatever. That's a risk they're paying attention to. They're not saying that's happening. Disinflation process, transitory, tacos. Okay, I don't think I'm going to see any of those. I'm just going to search the word trans. Okay, I got 4 hits for trans. All of them relate to transactions. Nope. Okay, no transitory. Okay, no trans. Stagnation. Dude, they're not going to say that word. No. Quantitative. Okay. Nope. Quantitative doesn't show up. How about, let's see here. China. I shouldn't say that. Although GDP growth in China improved in the third quarter, supported by an increase in industrial production, Chinese retail sales continue to be held back by low consumer confidence. This is old data because the Chinese data that came out like right after this meeting basically suggested that manufacturing is in a recession in China. I hope that's not offensive. I like the Chinese. The Chinese are good people. I just think the CCP is a little loony. Although they did announce a little bit more support this week here. Sufficiently restrictive. Yeah, I didn't see them use the word sufficiently, but let me see. Oh, here we go. Okay, yep, there it is. Good call. Good call. I like that. Shout out to Vince. Vince, if you're Italian, awesome. If you're not, still awesome. Good job. With inflation still high, most foreign central banks while keeping their policy rates unchanged, indicated intentions to hold rates at sufficiently restrictive levels. We need to reduce inflation by being sufficiently restrictive, keeping restrictive. Participants continue to judge that it was critical that the stance of monetary policy be kept sufficiently restrictive. Okay. Participants noted that further tightening of monetary policy would be appropriate if the incoming inflation data was bad, basically. Fine. Free Palestine? Nope. That's not in there. Middle East talk is in there. Hunter Biden's laptop. Oh, okay. Let's see. Hunter. Nope. Okay. No Hunter. Let's see. You know, they are so careful to talk about election stuff, but I'll type it in. Nope. No election. Electric vehicles. I don't think the word vehicle is mentioned here. No, it's not. And some of these are just silly, but they're also kind of funny. Israel. Oh, the armed conflict between Israel and Hamas left a limited net imprint on foreign financial markets. Basically, nothing has occurred. However, it could cause volatility. Bitcoin. Yeah, right. Mention of crypto hasn't been mentioned. Bitcoin hasn't been mentioned. Okay. Moon. I'm searching for Moon, and this is what JPow says.
Just close the fucking door. Close the door.
All right, let's see what the rest of the suits are saying. We're done searching now. There's nothing there. Good job for Binance getting busted. Freaking scam. Just like FTX, both were fraud. Much discussed base, but I already made a video on that. You can watch that video. Much discussed basis trade. Can't talk correctly here. The much discussed basis trade in treasuries by hedge funds. Gotta mention, this is basically the nonsense speculation that's been going on in treasuries. Not much really about China here. We already Command F that. On inflation, the Fed may be signaling that it's likely done with rates. Participants noted that inflation had moderated. Yes, we know they're done with rates, bro. Come on, man. Look, the Fed had a chance here to go bearish. They did not. They refused to. All they said was Palantir and Tesla to go up. Oh, wait. Palantir.
Lost the lead.
In other news, wow. Okay. Well, NVIDIA earnings today. I'll begin covering that on the Meet Kevin live channel. Make sure you're there. I want to be clear in the future, hopefully the near-term future, what I'm going to do is have the Meet Kevin app, which you can download in the Apple and Android app stores, give you access to all the videos and text-based summaries of the videos, just to make your life as easy as possible when it comes to finance. So stay tuned, stay subbed. I know sometimes it seems like Kevin can be volatile. Just know everything is entirely under control. Well, I'll put it this way. Everything's not always under control. I'm not going to lie. But I am doing my best with everything that we are doing. So I think we're doing a great job. Again, the NVIDIA earnings will be covered on the Meet Kevin live channel. When I close out this live stream, you are going to get maybe not yet. Okay, well, I'll keep doing what I can. But anyway, okay, let me see here. Let me see what else the suits are saying quickly. I want to see if Nick T tweeted anything before we wrap up over here. So let's go to Nick T quickly. Nicky T, what do you have to say? You must say something. Okay, Nicky T. Nicky T. What? Bro, where's Nick T? Is he on vacation? What the hell is this? No tweets from Nick T since November 16th. I've been freaking deprived. There's been so much going on, too. This is absolutely ridiculous. Whatever. What are you going to do? All right, so let's see here. Let's see. What else? Okay, well, I'm trying to see what people are saying on the internet. Now we've got Wall Street's comments, we've got my comments on the minutes, and what we want next is, let's see here. Let's get Notifications here. Okay, a few participants commented business contacts had reported that cost increases could not be passed to consumers. We covered that already. That, I think, is an understated, very big deal. As soon as businesses start rolling over and realizing they can't keep raising prices, that's when people, when you start seeing price cuts. Oh, which reminds me, the Black Friday sale is available on meetkevin.com. Okay, let's see what else here. Hawkish FOMC minutes. These were not hawkish. These were very neutral. Tesla is the most heavily shorted stock amongst hedge funds. And we already knew that. It's also very stupid. These hedge funds are going to get burned to the favor of actively managed ETFs, in my opinion. Oh, dang it. Now I have to press the button. Okay, I'm going to press the button while I keep getting more insights so we get this out of the way. Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate an actively managed ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker. Okay, so Rivian and Palantir both down 6% today. I wonder why. I know Palantir's down because the hype of the contract they were expecting ended, and so then they go down. Okay, I mean, that's like buy the rumor, sell the news. We've heard this a million times before. Rivian's product chief development officer moving to role of executive VP. Okay. Rivian CEO assuming responsibility for all product functions. What? Announces changes in product organization. Okay, that's interesting. That does imply some stress and some potential control. That's probably why, but that's the only news I see here. Invitae's become pretty volatile. Ubiquity is moving with business spending, and so is Bill.com. Ubiquity and Bill.com, I don't think will recover until business spending recovers with lower interest rates. So I think there's time to sort of build positions in that, which is what I'm doing. I have exposure to them. Trade Desk, same thing, although more medium and large businesses. NVIDIA earnings come up in an hour and 50 minutes. I'll be covering them live on the Meet Kevin Live channel. Enphase sitting at only down 0.5% today. Not bad. Recovered off the bottom pretty nicely. Tesla still holding on to that 2.5%. Dix gave up. Look at that, man. Dix was up 10% and just gave it up. Gave it up. Anyway. All right. Is that enough? Okay. Go press the redirect link now to make sure you are at my NVIDIA earnings call coverage. See you there. Bye.